Hello, everyone. My name is Jeffrey Kennedy, and welcome back to another episode of Market Academy. And we're going to kind of wrap up our discussion this week of the Kennedy channeling technique. And again, just to kind of recap, the main highlight is that counter-trend price action tends to be contained by parallel lines. Okay, we talked about that on Tuesday and yesterday as well, Wednesday. So by default, if you see price action not contained by parallel lines, then it's going to be impulsive or trending price action. Now, you might remember this price chart from a few weeks back. This would have been early July. And the reason I focused on it or shared this with you is because right here on this trading day, this would have been July 7th, we had a double close key reversal outside bar combination. Now, that's actually kind of an exciting bar pattern for me because a lot of times, not always, but a lot of times, it does coincide with a reversal, a trend reversal. Okay, so we were watching this double close key reversal, and here was the operative Elliott wave count that I offered at that time. And you can see, again, at that time, I went ahead and put on some of the base channel trend lines. So what we were essentially looking for was we were looking for prices to, pretty much turn up from at or near current levels, roughly $35 a share, and actually climb back above the wave 3 extreme, which was 45.31. Well, as you can see, we've clearly done that. We're currently trading 48.15. But the reason I'm coming back to show you this example is, again, how this trend line technique can aid you in identifying, the difference between a trending price move and a counter trend price move. And just to kind of clean the price chart up a little bit, went ahead and just went to a daily time frame here. And again, you can see back here in May, this time frame right here, we did see price move above the upper boundary line of the base channel. That confirmed the presence of third wave price action. So we would naturally be looking for something more impulsive to the upside. And that actually came, late May with the price gap up, the acceleration gap up, and then we continue to climb higher in wave 3. And then notice once we saw that wave 3 top back in mid-June, notice everything to the downside was indeed contained by parallel lines. And also, too, this equates to what we talked about, too, about a center line reversal, because notice the sell-off really didn't make it down to the lower boundary line of the corrective price channel. We just kind of stalled around that center line, and then once we got above the upper boundary line of the corrective price channel, that provided really strong, compelling evidence. It wasn't a guarantee, but it was certainly very compelling evidence that the fourth wave move down was indeed done, and prices were going to continue to climb higher. So let's just go ahead and put on a reverse Fibonacci technique. That might be something I do a lesson on, at some point. So we're very close to the first target, 49.77. Momentum is still strong. I'm not sure if we can make it all the way up to 56.99. So a lot of times what I do whenever I use this approach is I'll just go ahead and subdivide the distance between the 1.382 and the 2.0 into Fibonacci proportion. So that actually targets, say, 52.50, roughly up to, say, 54.20. So that would be an area. So since we're so close to 49.77, and I think wave patterns are incomplete, momentum is still strong, let's look for this target zone next. Again, roughly, say, 53, and then beyond that, 56.99 or roughly, say, 57. But again, this technique, again, just kind of really takes the mystery, in my opinion, out of actually being, falling down that rabbit hole and getting caught up in, say, the internal substructure of a price move. Now we kind of get back to basics, and those basic two building blocks. Is this a trending price move, or is this a counter trend price move? Is this a motive wave, or is this a corrective wave? Now let's walk through another example. I'm not sure if I showed this to you. This is a price chart of the trade desk, ticker symbol TTD. So blank price chart. So let's go back to that March-April time frame and just kind of start working through the process. So the first thing we do is we have an up-down sequence. So what we want to do is go ahead and put on initially what would prove to be a corrective price channel. Okay, so it's going to be ABC until we begin to break out. Well, we got finally the breakout. Of course, it was a big breakout, big acceleration gap. Now, acceleration gap like this, let me just kind of alleviate some of the disappointment, because if we did not get into, say, the buy side position prior to the price gap up, prior to that acceleration gap up, we might be going, oh no, I missed the move, darn it, and you might be frustrated with that. Well, let me alleviate those frustrations simply because, again, if you have price action, which you know in, say, a very compelling manner, equates to wave 3 price action, okay? Once you have something on the price chart that says, okay, hey, I'm definitely wave 3 price action. And that's one of the beauties of an acceleration gap, is because it clearly says that's wave 3 price action. Well, if this is wave 3 price action, all you need to do then at that point is simply be patient, because wave 4 will unfold. And then at some point, we're going to go back up again in wave 5. So if you miss this move here, that doesn't mean the party's over. It just means you need to be patient, watch, wait. And as you can see, as I mentioned when we were discussing a secondary value or purpose of the base channel trend lines, it often provides support for the fourth wave pullback. So you can see we came right back down. What's the most common Fibonacci retracement for a fourth wave? It's a 382. So now we have Fibonacci support. We also have trend line support. So you can clearly see on the chart that this area centered around 68 was really a great place for the market to fall to and then reverse from back to beyond the wave 3 extreme of 80.55. And then if we even look closer, you can clearly again see the movement to the downside, again, is pretty much contained within parallel lines. Yes, you did have a little bit of throw under on that lower boundary line, but none of those moves below the lower boundary line, again, were, had any kind of, say, longevity to them. They were just really spikes, kind of trying to feel and figure out where the bottom was, so to speak. And then again, of course, here's your base channel trend line support. So you can clearly see in the market that we had very, again, solid support centered around the 80 handle. And then, of course, we have the final fifth wave move up. And as far as the extent of that move, we've come already very, very close to the 86.28 number. We did have a gap here. Of course, I don't want to see the gap closed. Otherwise, it turns into an exhaustion gap. So I would probably say, hey, 74.72 is a good critical support level as we anticipate further rally into that 90.92 handle and potentially a high as, say, 96. So again, you can kind of see with some of the examples that I've offered this week, the clarity that the Kennedy channeling technique does indeed offer. It allows you, I think, of the ability to identify wave structure more clearly. Now, not necessarily the substructure, the minutia, the finer, those smaller subwaves within price moves, but as far as the bigger picture, getting that right, is this a motive wave or is this a corrective wave? Is this a trending price move or is this a counter trend price move? I think this technique really goes a long way in helping you or aiding you in that ability. Well, that's about it for me for today. Have a wonderful weekend, and I'll see you next week.